Section 4. You will hear part of a lecture on the U.S.-China trade war. First, you will have some time to look at questions 31 to 40. Now, listen carefully and answer questions 31 to 40. Good afternoon. In today's lecture, we will examine one of the most significant developments in international trade policy in recent decades, the U.S.-China trade war, focusing on its causes, evolution, and projected long-term effects. This discussion is based on a comprehensive study by George Alessandria and others, published in the Journal of International Economics in 2025. Their research offers valuable insights into the economic dynamics and evolving expectations surrounding the U.S.-China trade war. Let's begin with the backdrop. In 2018, the United States, under President Donald Trump, initiated a series of tariffs on imports from China. This marked the formal beginning of what became known as the U.S.-China trade war. However, contrary to common expectations, there was no prior market signal indicating an increased likelihood of trade conflict. The study shows that between 2015 and 2017, U.S. import patterns exhibited no anticipation of tariff escalation. Trade elasticities remained stable, suggesting that firms did not expect a policy shock. Initially, the tariffs were expected to be short-lived. In 2019, models estimated a 74.5% probability that the U.S. would revert to normal trade relations with China within a year. However, by 2024, that probability had fallen dramatically to just 20.8%, reflecting growing expectations of a prolonged, or even permanent, trade conflict. An intriguing finding from the study is that although Trump imposed the tariffs, he simultaneously reduced long-term tariff expectations, primarily by diminishing the perceived risk that China would be reclassified under non-normal trade relations, which would have resulted in even higher tariffs. Under President Biden's administration, while no new tariffs were introduced initially, the expected average future tariff increased as the trade war became more entrenched and long-term prospects of peace diminished. So what does this mean in practical terms? The research models trade policy as a Markov process, meaning policy shifts are probabilistic rather than deterministic. Chinese exporters are shown to respond not just to current tariffs, but to their expectations of future policy. When uncertainty is high, firms are less likely to invest in foreign markets. Thus, policy credibility plays a critical role in shaping trade dynamics. For example, the trade war's effects mirror, in reverse, the trade liberalization that followed the U.S. granting China conditional normal trade relations status in 1980. Then, as now, firms adjusted slowly due to policy uncertainty. Over time, as expectations stabilized, trade volumes responded accordingly. Today, if expectations continue to favor a long-term conflict, U.S. imports from China could stabilize at significantly lower levels. In some scenarios, as much as 0.75 log points below pre-war levels. What's especially important is that the current trade environment is not simply about tariffs. It is about uncertainty, about geopolitical shifts, and about how firms internalize risk over time. In our next session, we'll explore how this shift is influencing global supply chains and regional trade agreements.